Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, key economic indicators are now all pointing lower. In the US, the advanced June new orders report for durable goods was up 2% from May, but with zero growth from the same month in 2018. There was a further sting in this data because the May data was revised sharply lower. Retail inventories fell, wholesale inventories rose, and the US merchandise trade balance deficit came in slightly worse than analysts were expecting, and they were expecting to see an improvement by now, but it didn't materialise. None of this impressed equity markets, and today's S&P 500 is down 0.4%. Earnings reports have been missing analysts' expectations, even though companies have been trying to set them lower anyway. And the Atlanta Fed's GDP Now tracker has set their second quarter growth estimate at 1.3%, a reduction of 0.3%. Next week in Shanghai, there'll be another face-to-face meeting, this time to try and patch up the trade agreement with the US. But expectations are low for progress. China seems to be in no mood to concede anything. In China, there is more evidence that the yuan is making virtually no progress on the international scene as a payments currency. SWIFT says that 1.28% of transactions in June were yuan denominated. That is virtually the same as the 1.25% in May, and is miles less than the 45.9% for the US dollar, which is rising, and the 32.1% for the euro, which is falling. Shanghai rose 0.5% yesterday, however, and Hong Kong and Tokyo also gained. In Germany, businesses see no recovery ahead, and the influential IFO survey of business sentiment there paints an increasingly sombre picture of the world's fourth largest economy and the heart of the Eurozone. It's actually 40% larger than the UK. The downward track is worrying the ECB as well, and in their overnight review of monetary policy, Draghi acknowledged things are getting worse and worse, especially for the region's factories. The ECB said it's ready to restart a stimulus program. This gloomy outlook hit the German stock exchange hard, with the DAX down 1.3%. Other European markets didn't react as negatively, however. In Australia, their central bank signalled they're prepared to ease policy again if required, and said Australians should expect an extended period of low interest rates. This was something of a surprise to the markets, who had expected them to declare the end of interest rate targeting. But instead, the RBA defended the policy. Savers are facing severe outcomes now. US Treasury 10-year yield is marginally higher today at 2.08%. Gold is down $5 overnight to $1,416 an ounce. And US oil prices are marginally firmer today. They're now at $56 a barrel, and the Brent benchmark is just on $63 a barrel. And the Kiwi dollar is 0.5% lower today at 66.6 US cents. On the cross rates were softer at 95.9 Aussie cents, and against the euro we're down to 59.8 euro cents. That takes the top off the trade-weighted index to be just under 71.8. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.